Welcome to Narayan's Weekly Wraps. I am Viv Kavinda. This week we're going to look at US GDP numbers and what they mean for interest rates going forward. We will also look at EU inflation expectations, as well as some predictions about global growth rates, especially in the developed countries over the next few years. Then in our AI segment, we're going to focus on robotics. Google just released a new robotics model from DeepMind called I think it's Gemini Robotics. And the reason I would look at this is that I think that if you look at the kind of expectations with regards to growth rates, etc., that we are seeing coming from AI, a lot of it has to come from embodied AI, real world AI, not just symbolic and things like what you can do in a computer, but what you can do in the real world as well. And I think this is an important aspect to look at. So let's start off with US GDP numbers. US GDP came in a little hotter than expected, showing that the economy was growing a bit faster than people had anticipated. We also saw jobless claims numbers a little lower than anticipated as well. These combined to make us believe that maybe the US economy is a little stronger than had been anticipated. Now, what is important here? Remember, we've been getting some economic numbers from the US, especially jobs numbers from the US, that have been worse have been revised worse. For instance, we had this number of about 1 million jobs that were overestimated in the last year. So the year until March this year, the estimates that we had been getting from the US government's statistical agencies had overestimated jobs by about 1 million jobs. And the argument out there was that maybe the US economy is a lot weaker than we anticipated. And we were basically operating in a very weak economy. And that was causing belief that the US Fed was going to have to cut interest rates very quickly, very strongly. And that was why we saw markets rally as strong as we did for the last little while. Now, if we are seeing indications that maybe this is not true, maybe there are indicators of, firstly, strength in the overall production in the country, as well as in the job market. Those two things, especially when we see that inflation numbers are still reasonably high, that means that overall we should be anticipating the Fed would be a bit more cautious about interest rates. And that would, I think, be negative for the market, especially at these highs that we are right now. Not just for the market, it'll be negative for the market, it'll be negative for emerging market currencies, stronger for the dollar, negative for things like gold, negative for things like Bitcoin, etc. And especially, I think, for tech stocks, which obviously are more future orientated. And if you have lower interest rates, the penalty of looking at the future is much less. To understand what that means is, if you have a high interest rate, money in the future is worth less now, because you obviously have to discount the value of the interest rate. If the interest is lower, money in the future is worth more relative to when interest rates are high. That means that low interest rates kind of favor growth companies, because growth companies have all the revenue in the future versus value companies which have the revenue right now. And a lot of the growth that we've seen in the stock market for the last couple of years have been in these growth companies, things about the future, AI, etc. Lower interest rates, good for them. High interest rates, or maybe interest rates not being as low as we thought they might be, bad for them. And that's why we might be seeing a bit of a pullback there. So what is the conclusion about this? Personally, I don't know what is happening with the US economy. I don't know what's happening with the global economy at the moment, because we are getting these massive revisions. Why is that important? I've been saying this for a while. I don't know if we are seeing enough of an impact yet, when we possibly are seeing it, of AI and automation that is changing the structure of the economy in the US and other parts of the world in a way that's significant enough that when we do these sampling techniques, and this is how all these surveys, these things work, these numbers work. You want to know what's happening with regards to growth, you do a sampling. You want to know what's happening with regards to employment, you do a sampling. Very rarely do we get actual ground numbers. Why? Because economies are huge. It's very difficult to go measure things accurately. The US basically only does a census once every decade or so. It's a very difficult thing to do, to know exactly how many people are there, what they're doing, etc. The toolist economy like the size of the US, you can't just get monthly numbers that reflect the actual state of the economy by looking at every single thing that's happening there. It's impossible. So what you do is you do samples, and if you're sampling and you're using those samples in a model, and the underlying economy has changed, the model is no longer applicable, and therefore the sample is going to give you the wrong answer. So that could be what's been happening here. And if that is the case, then the Fed and everyone else out there that's trying to make economic decisions about how to operate in this economy will probably get things wrong. So like I said, the GDP number said one thing, the employment number said another. Let's see how this kind of works out over time. Next, we saw EU inflation expectations rise slightly, and I think that is another concern to be looked at. Inflation has been coming up for a long time. It's still in many cases higher than we would like. remember, they have these inflation targets that they need to hit in developed world countries. These inflation targeting is a technique that's used to basically control or to determine what interest rate should be, because it is a way to give the market an objective measure as to whether or not the central bank is acting in a responsible way or not. And the fact that we are seeing inflation starting to rise, or expectations starting to rise in a place like the EU, is a bit of concern, because we haven't gotten back to the level that we thought we would get to, or we want to get to. The 2% or lower inflation rates that historically we wanted to get to in like the developed world. And if they're starting to rise already, that could be a concern, because it could mean that not only are we not getting to the level we want to get to, but we're getting further away from it. That could mean, that central banks will have to react in a way to counteract that, which means higher interest rates, which, as I mentioned just now, obviously are negative. And then finally, I'll look at OECD expectations for growth. So we've seen a slight drop in growth rates for this year, next year, and the year after that, basically 25, 26, and 27. So it's about 0.1, 0.2% per year over the next 3 years. That the OECD is saying is that growth rates are going to be basically downgraded from what they expected before. So by 2027, we're looking at growth rates just under 3%. Right now, we're looking at growth rates just over 3% for this year. And the reasons being given is uncertainty as well as tariffs. Now, the tariff situation, I think, is quite rather important. We are seeing indications out there that, because of the uncertainty in tariffs, I mean, just right now, as I speak to you, I've seen new reports of new tariffs being announced for things like pharma, etc. That is translating into, a lack of investment. Uncertainty raises the cost of investing, because you don't know what the downside is going to be like, and therefore you're not going to invest unless things are much, much more attractive. And we are seeing, where the economic growth rate is uncertain, where we have a changing economy, and yet at the same time, we don't know what's happening with regards to tariffs. These are all combined to give us a very uncertain view about what's happening with regards to, where to invest and where not to invest. That could be one of the drivers that we are seeing that's pushing through and forcing down, growth rates over the next, say, couple of years. Now, understand, these are just forecasts, and these institutions don't always get things right, but they do look at the current situation. They do give us an indication as to what experts are thinking out there. And they are, if you look at experts, they're probably one of the most informed experts out there. And you would expect that businesses and other decision makers out there in the economy are going to be looking to this information, or looking to similar kinds of data sets and drawing similar kinds of conclusions about growth rates, which would mean that it's almost a self-fulfilling prophecy, where if you see or expect growth rates to be coming down, you can invest less, which basically causes growth rates to come down, if you get my drift. Now, moving on to robotics. So we had a new report from Google this week, Alphabet, from DeepMind, that they have a new robotics model that they've been releasing. Now, this robotics model is obviously far, far behind what the large language models are like, real-world interactions, etc. But they are integrating the large language models into the robotics. Why? It allows you to ask the robot to do things in normal language. You pick up that bin. The large language model excuse me, identifies what a bin is, and if it's multimodal, can detect what a bin looks like, and then the robot can react on that information. So there is an integration part of it. But what we have found is that robotics is a far, far harder problem than computer-based tasks. I would expect in the next, say, 2 or 3 years to get to a point where the majority of things that can be done on a computer, AI can do it. I do not expect that to be true of things that can be done in the real world. Why is this? Well, it comes down to how human beings operate. It's like a fact of how evolution has worked. If you look at what human beings can and cannot do, the things that we can do kind of universally well, operate in the physical world, that took a lot of evolutionary time to evolve. It took lots and lots of time to get the ability for us to interpret the world, to understand what's happening in the world, and to manipulate the world. It's not talking about 1 or 2 million years. We're talking about hundreds of millions of years, billions of years. What it took to develop a brain that went from a chimpanzee's brain to a human brain is, probably in the region of about 5 million years or so. We're talking probably 1/100th, maybe even more, or maybe less, of the amount of time to get from, operating the physical world in any reasonable kind of ability to versus basically developing a brain that can, do the things our brain does. If you look at human abilities that are variable, things like playing chess, things like writing, things like composing music, etc., we have found that actually these are the things that the AI does the best. If something is very variable among humans, AI does it very well. So if humans basically, we could play chess, we had a machine that could play chess and beat human beings at chess far, far quicker than we had a machine that could talk at the same level as a 10-year-old. Okay? That indicates that, obviously chess is a more variable thing. Speaking like a 10-year-old is something more common. And we would assume that evolution spent more time focusing on the speaking like a 10-year-old than on the circuitry to play chess. Therefore, chess was the easier problem to solve. The same thing applies to robotics. Robotics, because it involves something that took a lot longer to evolve, a lot more difficult, problem to solve probably. We would expect that it takes a lot longer for AI to solve that problem than it was for do the stuff that that basically separates us from the chimpanzees. Okay, the stuff that separates us from the chimpanzees very quick in terms of evolutionary time to evolve. Therefore, it's not as difficult a problem to solve. I've said this many times. If you look at Magnus Carlsen, the world's best chess player, maybe the best chess player of all time, playing chess, in objective terms, absolute difficulty terms, the most difficult thing he does when he goes to play a world championship chess, he doesn't play anymore, but he used to, was not playing the chess game. It was walking up and sitting down at the table and moving those pieces. That was it. The actual chess stuff turns out to be a rather simple problem for computers to solve. Getting a computer that can actually walk up, sit down on a chessboard and play the game by moving those pieces like Magnus can do, that's a far more difficult problem. Now, bringing us back to Gemini and what they're doing out there. One of the bottlenecks we have with robotics is that we don't have the database that we have with regards to text and other kinds of intellectual property. So intellectual endeavors. So you want to play chess, lots of chess games out there, lots of information on chess. You want to basically write books, there's millions of books out there, you can basically read them all. You want to basically cook an egg. What's your data set? Where are you going to get the data from? What they've been using right now, they've been using videos, using world models, and they've made some progress there. I mean, Google's or Gemini's recent world models, or I should call it DeepMind's world models, have been getting a lot better. They've shown examples in where this thing can basically generate a 3D world and operate within it with reasonable, impressiveness. But the data set that they're working with is far smaller. You don't have millions of examples of people embodied robots trying to cook an egg, okay, and doing it successfully. It's not there. You have millions of examples of sentences, of words, of ideas, that kind of stuff that you can put into computers. In fact, one of the things that really helped computers or AI do as well as they have done is inputting, programming, language into it, examples from, of programs, computer programs, because that gave it a lot of data to work off for logic, etc. So data is obviously a problem. Next, it's safety. You can run, or scalability. Sorry, you can run, huge data centers and just basically input this data from, the internet about language and pictures and whatnot, and it just run for months and use huge amounts of computing processing power, etc., and kind of get correlations that will work out. How do you do that with the physical world? You need to have actual robots out there. Far, far more difficult problem to scale up, where you need to have thousands or maybe tens of thousands of robots basically operating the world to basically get the data that you need to basically find correlations about the world. Okay, and then finally, it's also the fact of, like I said, it's a more difficult problem. It's something that took evolution a lot longer to solve than it took them to solve basically, the human brain and the high end level of the brain. But that being said, I do think whoever gets to solve robotics first is going to have a massive advantage over the next competitor. As much as we like, chatting to ChatGPT, as much as you might like, having it write you some whatever out there, it doesn't quite translate into the same way in economic and other, factors as the ability to have a robot go underground and mine for you, to have it build chairs for you, to basically have it cook meals for you, clean your house, operate machinery, those kind of things. And I think that whoever solves that next is going to be an order of magnitude or maybe more important as a company than the LLM models. And that is one of the reasons we have like BYD, while we have Tesla in our portfolios. Because quite frankly, these companies have not performed as well as like a Palantir or a Microsoft or an Alphabet, etc. But if you had to look at what the future actually holds when it comes to, where the biggest like prize is when it comes to AI, it's not going to be about AI that can do scientific research. That's nice. It's probably going to be important. But if you had to say, bet on this company where AI can do scientific research, bet on this company where AI can build robots that can actually do physical labor, like blue collar labor, I would think the most money is going to be in the company that does blue collar labor. Okay, and that I think is why we need to have this real world physical aspect to our investments as well. Okay, that's it for this week. Thanks for joining me. I look forward to speaking again next week. Cheers.